certainly so. I'm a 25-year allocator across pension funds, endowments, and foundations, and also have had roles with GC and MLT. And leading a company, I co-founded Williams Capital, which today is the largest limited and minority-owned Brookfield investment bank. I left after 16 years. My colleagues kindly achieved that status 3 years after my exit. I left to focus on climate tech, fintech, and wealth management. I'm an institutional guy trained in private equity middle market and saw the capital stack merging 10 years ago, as I'm sure all of you did. Some of you are native in family office space, and I've learned a lot from many of you in this room. I saw the capital stack moving to asset/wealth management, so I left to focus more on wealth management and seat at the Episcopal Church Endowment Foundation, $3 million, doubled the assets in 5 years, doing nothing sexy. Just they couldn't afford someone to do what I did. I'm sure all of you would have had that opportunity, do the same thing, but it put me squarely in the wealth management space. And I concurrently had a political appointment at New York State Common Retirement Fund overseeing their sustainability and climate portfolio. So for me, it was such a privilege to be in the asset management world from a large pension fund space and in the family office space, endowment foundation, and be able to focus on mission investments with 100% financial returns and social impact. So going down that curve, both financial returns and social impact, depending on what the stakeholder thought in terms of additional returns and how that was measured. And I always use the UN PRI goals. The New York State Common Retirement Fund follows 9 of 17. I speak to high net worth individuals, family offices who have not done it before. I say, let's start with one, and let's talk about how we're going to measure that and monitor that and what staff we need involved. So it's been a lot of fun in my exit, and Climate Week was amazing. I think I heard someone here speak about...
Given all those hats,
yes.
What's exciting you and scaring you in this context?
What's exciting me is the broad conversation globally. Honestly, nothing scary me, but what I replaced that word is what I'm spending more time on, making sure I'm on top of. And I think you guys said at the panel on it, is AI. AI and climate tech has really transformed, frankly, nature-based carbon credit solutions and other types of nature solutions, given the drone application and collecting data. So AI is in emerging technologies is what I'm coming up to speed on, and speaking to individuals that know significantly more than I, and how it plays a role in companies.
So, thanks to Eric. As we were together, mobile solar, Zanzibar, so we should go through this. Our world collided, we went to a conference there, but you've been an impact-oriented thinker investor for a while. Invited me to your fourth project edition. How are you seeing the world today?
Talking about Zanzibar, right, in Europe, that was my walkabout. So honestly, I mean, it was really interesting to see what Zanzibar was. Green island. It's pretty virgin in the sense that a lot hasn't been done up there. And I'm very happy. I just posted Good Morning Zanzibar, and Mark saw that I was in Zanzibar and said, "You should go to this conference." And I was there with my family, you know, my brother, my siblings, and my sister hosted a big birthday party over there. And when I said I'm going to a conference, they said, "Foreign conference in Zanzibar." They couldn't believe it. But I went there for 2 hours, and I was very lucky to go at the right time, because they were talking about smart cities, and then I got a chance to see exactly what they had achieved in terms of really building smart cities, sports centers, and everything else, and bringing universities into Zanzibar. So the MIT of India, which is IIT, has moved to Zanzibar, and then Princeton University is opening an economics department. And it's really heartening to see that, because then the rest of Africa, right, they don't have to fly all the way to Europe or come all the way to the US. they have access to their education and to a nice lifestyle, clean space, everything in Zanzibar and close to home. My family lives in Dubai, and my cousins are growing up in Dubai, and they're coming to the U.S. They're actually studying in the UAE now, doing medicine or whatever. And the UAE government is giving them golden visas because they really don't want them to leave the UAE. And these are like 20-year-olds and 21. So I go around the world because I like to see best practices in terms of, at the end of the day, we try to get all this together and to see how you can add value to the world, because you need the knowledge to be able to do that. And when I was in Eastern Europe, what I really love seeing over there is people aren't greedy. They're very happy with what they have. I've got a lot of green technology, windmills and solar technology. And because they're later on, they're later in coming into this, I think they can adopt the best practices. So that was really interesting. And in terms of philanthropy, I'm involved with community access. And what I love about community access is they're building these new, clean buildings and helping people with mental health and homelessness. And so when you live in one of those apartments, your mental health problems disappear. Because it's a beautiful, clean, sunny space. And you get to bring your family there. So there are a lot of women who've been single mothers, homeless, whatever, have had access to housing and skill sets and community gardens and everything else. And then I'm also on the executive board of Working Nation, which is upskilling, job skills, and all of that. So that's a little bit in a nutshell on what I'm interested in.
So, then why do you think portfolio moving to clean tech? You talked about it earlier. There are maybe a certain segment that you said about. Obviously, the IRA is driving some of it. Tech shifts or otherwise.
Yeah, I mean, I talked a little bit about nuclear, talked about kind of building that kind of around the new. We talked about retrofitting, like some old technology into both. I think those are interesting. So the other area that I haven't really talked about that I think is sort of the clean minerals. And I think you, Stephen, mentioned this earlier, right? You sort of see China hopefully trough at this point. And we're at this point where a lot of these minerals that people looked at as, what's needed to fuel clean tech, prices have gone down, right? There was a lot of excitement in exuberance in kind of the prices of copper, rare earth, silicon metals, cobalt, lithium a year and a half ago. And I think we've seen that come down because at the end of the day, it is still industrial demand that drives these, the price of these metals and basically what prices supply demand. So I think that's one area where we are excited because I think if we look 2 years out, and it's not all of them, right? We look at lithium and I look at lithium and I think there's huge supply that we have. So I'm not excited about that. But I think something like silicon metal is somewhere, where we are kind of allocating capital because uranium. Uranium. We started to see uranium. But I think copper too is another one. So copper and silicon metal are really the two ways. So one, we look at copper and we think there's a scarcity of incremental supply. We think some of things to put a mine online is going to take a really long time, and we think obviously electrification, electric vehicles drive demand there. And silicon metals is the other one, just because again, what you're seeing with a lot of the onshoring is a need for supply needed to a particular nation. So, silicon metals, for example, we're in a company that's basically has 2/3 of U.S. supply of the metal. We look at solar and we think in 4 years, the amount of solar that's going to come on the market is basically going to take something like 2/3 of U.S. supply. And so we think that drives up. And again, that's aside from all of the industrial demand of silicon metal, like, semiconductor chips that it goes into. And so, we think that drives prices up, and we think this is the way we play it because a lot of that supply is effectively being kind of isolated to the nation, that needs it. And so, I think that's another area where we think, we're finding great, value just because of China, right? Because these are industrial metals today, and we think they're clean tech metals for years. For years.
In terms of green energy, have you seen any impact of, say, solar and wind just because of interest rates being up? In terms of adoption?
I think residential.
I'm sorry, just,
Yeah, no.
I should have chosen you as the moderator.
I was, do you want me to answer that then?
Yeah.
Mr. Moderator?
Then I want Anthony the.
Yeah.
And then he has another question.
Okay, all right, so I guess what I would say to that is, I think residential solar, you're definitely seeing that, because I think utility scale solar, utilities in the US obviously are pushing to decarbonize, they send that out to the rate base, the price of utility scale solar is no different really than legacy fossil fuels. I think residential solar was one really subsidy-based, really interest rate driven. Interest rates were low, you could justify, putting these panels on a rooftop. I don't think you can really do that as much anymore. And the last thing I'll end with respect to the public markets is you've seen this in the clean tech ETFs, right? Because if you look back, a lot of the companies that were public in the clean tech space have all been, a lot of these residential solar companies, right? And big solar,
panel.
Sunrun, yeah, and they have. And you look at the ETFs, and people look at that ETF and they say, decarbonization, can't play it in the public markets. But I think the key is that there are so many new businesses that, are decarbonization 5 years today, right? Like our businesses 5 years from now that'll dominate the space. But to your point, residential solar is not that anymore because it's so
Yes.
Sorry.
So time it, let's talk.
What do you want me to talk about, Mark? I'm an old man. So I think that I'll interrupt, further get a question you can ask both of them.
Sure.
What I see, got to look at things 360, and all of us in this room have a responsibility to look at it more ways than we know how, and really challenge ourselves. Part of the utilities and the solar are depressed because of the interest rate differential you can get 4 to 6% risk free. So the utilities next year is at an unprecedented 30% drawdown. It's not because they're the largest, not because they're the largest green energy provider in the United States. So why am I saying this? Because often what we're getting is far more complex than what one might think of the obvious reason why something's moving in a certain direction. So a bit about my genesis, just to provoke you. I'm from South Africa. I'm the son of a mining analyst that worked at Old Mutual, which is Boston, Johannesburg, London. And, so going forward, maybe 10 years ago, I got involved and was one of the first 4 people to work for a guy, not work, but help to amplify them. He said, I want to eradicate poverty. And had the support of Droga 5, which is now been acquired by Accenture as their advertising. And so we scaled that with the support of the Gates Foundation Bank to an organization which has raised through corporate and government bodies tens of billions of dollars that have gone to actual ground use change to eradicate poverty in various ways. One of the events to publicize and make it viable was to do a concert in Central Park, the last of which was late September, where you've got 80,000 people, a free concert, and then a few that pay to play for tickets. You get a AAA list of performers, and interspersed with politicians talking, and Hugh Evans, who's the CEO and co-founder, would provoke and ask, and he went from being kind of just a kid that a friend of Prime Minister and had a British law degree to hanging out with heads of state and heads of corporate and really building a viable company with 400 employees as a non-profit, but really an advocacy organization. By being there, I met a lot of people globally that are tied into what you might call and what's become populist, which is unification of the world, so on and so on and so on. Separate from that, my son has worked only at a couple of places, but he has 3 degrees. And the last place he studied was in Russia. So his first job was with Gazprom BASF, which really never happened, which was a joint venture, maybe 14 years ago. And so he then got a job with a company called Telia, 50 Hertz, which is an energy grid operator, which is publicly listed. And so he, being a German kind of snail corporate company, evolved through the ranks. And so I've seen how they have greenified a lot of the energy they buy in is not that energy. But I also saw the fall of Uniper because the gas line was suddenly cut off, so they had gas coming cheap from Russia. Suddenly it wasn't cheap. So the cap table went ballistic and the company collapsed. Uniper, which was a publicly traded energy company, those who don't know. And so the German government bought 80% of the company to keep it solvent, keep the lights on.
Investment company, the company bought. My thoughts on
What you've heard, and final thoughts for you.
so the final thought some of you is in my view, carbon. One of the areas that I'm focused on is the carbon credit, a nuanced market today, plagued by all of the greenwashing issues. Played by charlatans and all of the, that's a better word than greenwashing.
Financial engineering.
The good news is that there were many technologies, not just the company I'm advising, there are more, that have addressed the trust layer that's missing with the use of emerging technologies. And that is inclusive of AI. There's nature-based carbon credits, there's engineered carbon credits, nature-based in the forest and the biodiversity and all those wonderful things. Today, they're not scalable. Engineering carbon credits are scalable. I've been focused on engineering because I don't have much time left, having built two companies, and that's what's scalable. The good news is that AI will help nature-based expertise scalable, but the bottom line is, who can we really trust? And blockchain-based carbon credits with the right structure, with the right credit agents. There's 3 now credit rating carbon credits, C0 is one. Our team layered on one of the big 4 because I said I'm Googling C0. Guys, we need one of the big 4. So we PwC, Deloitte, and KPMG came in, chose one of the 3. I'm not here to advertise any one, but my point is, having independent third-party verification, in our case times 3, available to anyone with a computer anywhere in the world that is on the blockchain, in our case Polygon, but there are others, is the trust layer that's missing. And I won't go into the emerging technologies in terms of being used, the drones and all the good stuff, but that's what I'm excited about.
Would you mind coming on a Zoom or think about the carbon credits more?
That would be my question. And please excuse me, and thank you so much for letting me come today.
Yeah, question with regards to ECG, the ESG trends. There's been a big sell-off, of late, and there's been a lot of pushback, showing that the returns don't actually meet it, and especially in a high interest rate environment, a lot of the hedge funds are very, bullish on their positions of these big trade-offs and shorts. How do they see that affecting them?
Yeah, I mean, very bluntly, I'll say, we're just focused on those things. And we think the government should make money to give it to the health and all the kind of capital allocating investments. So I'm not, best equipped to talk about kind of ESG standpoint. From my perspective, I think it's really, what are the businesses we like, what clients we think. From a ESG, I don't know.
And the public market.
What exactly is some of those companies?
So I think one would But, yeah, it's the price of silver metal doubled in the next couple of years with all the lower and the other companies trading 10 to 11 times. Every concentrated that the gas center was free. So and we think those are kind of sorry.
In the public markets, I think the problem they had is you can do it in the private space because you're looking at one company and you can track the company all the way through. If you're BlackRock and you're trying to do, no offense to the largest manager in the world, you can think about all the companies they own and all the subsidiaries of the companies that those companies own and all the vendors that they use. How do you track to make sure you're hitting all the, not having those things? So we actually didn't think it was very practical in the public markets to say you can assure what your ESG standards are when there really weren't that great a standard to begin with. In the private markets, it's much easier to look at a company and follow through. So I think it will bleed into it through best practices of the private space coming into public markets. But I think to advertise it as a public market manager saying that you can guarantee that you're committing to the standards is very difficult. So that's part of the reason why we didn't go that way. The other thing is, as a philosophical bent for ARS, we always believe that make money for clients, let them choose how to use it, was really our bias because those two things come together. I think he's expecting to keep going.
No, I'm trying to, I'm asking Peter if he'd like to chime in on this.
Join us.
As you do, maybe just introduce yourself a bit.
Sure. Quickly, single family office, the students family office, we invest for social justice, narrowing racial wealth gap, climate solutions, and energy transition. Manage a portfolio includes public securities and fund interest. We don't really invest directly, although we're about to do our fourth direct investment. So never say never. That's because two of those companies are relevant. So times happy. One of the things I wanted to actually mention is we're going through this sort of polarized time around anti-woke initiatives. I think something like 20 to 50 states have attorney general that are promulgating impediments to investing with the use of ESG data, simply even reviewing it. And, I find it kind of being a 25, 30-year Wall Street guy. We're first generation of single family office. I'm a Wall Street guy. I ran hedge fund, sold an asset manager. So, the idea that elected or appointed officials would tell people that they can't use data in making in evaluating, just I find it anti-democratic, so it just runs me completely the wrong way, particularly since elected officials, state attorneys general, are not fiduciaries in the true sense. They don't have an obligation by law to look out for the best interests of people.
That's the reason that they're giving them. They're saying that they're minding the people because and they've got inspired by that because it's saying that the ESG data is fake, false, not fraudulent, but fake, false, and deceptive. And came from some of the firms like BlackRock. I'm not making a comment about BlackRock, but that aggregators promoted baskets of public equities, for example, gave them a title. They were not necessarily distinguishable from traditional ETFs, and they decided that, halfway biased. So you had Microsoft and Google, and those were the top ETF constituents within the ETF. Then they had to retro-engineer and justify why, I'm just using was ESG. And then if you take those UN principles and any other third-party way of dissecting it, you're forcing yourself to tick a box because, you know, then you're talking about gender equality, race, geography, carbon emissions. You go through this, how you treat the people. And it's, you know, trying to fit into the box rather than saying what's inside the box. And I think that's why.
But I, as an investor, I should make the decision if I want to invest with idiots. Rather than have an attorney general.
That's why they did it, and I'm not defending it, I'm just saying.
Well,
I was saying the public are not in a position to know, and that the big asset managers really are.
However, the big asset managers are fiduciaries of that money, so their decisions are actionable in a court of law. So what we're seeing is this weird intermediation where lawmakers, without an obligation to us, are trying to limit our ability to look at data. And the professionals who are true fiduciaries and act where it's actionable, their behaviors are actionable, are being told by attorneys that don't really know anything about markets. You can't consider this. When in fact, all the SGA data is data. You can choose to look at it or not. So whether or not a product is fallacious, and I would agree with case, right? I totally agree with that.
That's the second component that I agree with you on.
But, you know, if you think about it, 90 years ago when the SEC was formed and they were, you know, the SEC was created to help foment the capital markets and drive capital formation, that shareholders, and 90 years ago they said, hey, you know what, public companies, you guys should produce audited financials. And the same sort of uproar occurred, as we're seeing now with ESG data. That's too expensive, it's not uniform, how do we look at different companies? It's sort of the same messiness that we saw 90 years ago. Here we are 90 years later, and the SEC thinks it's, hey, you know, companies, you should produce this data. It's kind of like, you know, the 15-year-old gets told by a skin doctor, I'm going to give you medicine, your acne is going to get worse before it gets better. We're kind of in a messy time, but it's going to improve. And we're in this place where I really think that professional investors need to tell the government that this is not okay. We don't want you wading in and limiting our rights to make dumb decisions with money. That's up to me to make a dumb decision with money.
Peter, I don't know you brought this up in the scope of things. Does it get better after sort of a presidential election, or how do you think this plays out?
Well, what I'm seeing and what I'm hearing from people involved, there's a nonprofit called CERES, CERES, like they're really involved in this, what they call the Freedom to Invest movement. And what they're seeing is that there's becoming sort of bloom coming off the rose on this anti-woke sentiment that because there's this huge disconnect that, you know, the majority of public asset managers and money, the majority of shareholders and people, you don't use the ESG and attack them, and you say to anybody, would it be a bad thing if a company covered up lawsuits around environmental damage or social, social injustice, like the wage gap between men and women? And all people will say, you know, 65% of people are in favor of all the things related to public companies providing data, when you put the ESG moniker in it, because, pardon this jocular expression, but evil is really good at marketing, you'll have, well, ESG is a bad thing, right? ESG is a bad thing. So if you talk about businesses being transparent around environmental, social, and governance, what you hear from 65–70% of the people polled is that they're in favor of that. When you use the ESG acronym, it's used around 60–40, but you still have most people.
So Peter, I really think that we should go in the future that we should even have to talk about this. Because it's, you know, I mean, if you want to invest in a company, it should be a company that covers all of that naturally, right? Taking care of your employees, taking care of the environment, taking care of your society, all of that should come very naturally. It should not be a lens. And investors should invest in the set of companies without having to look at it from an ESG lens. You can practice, I know a lot of funds that basically do the ESG thing and then they tick the boxes. And I'm like, that's not the way to do it.
But we're sitting,
Yeah.
for the most part now, geographically in the USA. If you're having this meeting in London or Europe, where you're very frequent and you're familiar with, it's embedded into the investment culture, even as a matter of law. And just to play or be in that space, to be featured, you're compelled by regulators
I think that's a
to
good
bring
thing.
ESG to the forefront.
Yeah.
Not to say that you're
Yes.
more or less compliant, but you have to disclose, right? You have
Yes.
to come to the cards and the table.
I mean, it should be a part of doing business.
And that's what it is, you know.
Yeah, and I think,
Particularly with AI and blockchain, the Europeans are forcing it, Americans are being hands-off.
and being transparent, right? I mean, being transparent is so important. I mean, whether it's companies and basically, I think governments should be a lot more transparent in terms of their money.
But personally, I think it's okay, to say that this is where we stand. You know, if I had a fund, I would say this is where we stand, and I would be frank about it. You know, whatever side I was on. But I think a lot of the mantras tilt artificially to saying we're fabulous in ESG when it's not.
Yeah.
I think here more so, I think in Europe people are more pragmatic because I think it's a higher hurdle and accountability.
Yeah.
And they'll say, you know, we're really not that, you know, this is where we are, this is where we aren't. Or we really have no regard for it because we're here to make you money by what it means. So I personally think that the projection continues of 800 billion between New York, Calvin and Calvin of carbon, black oil and energy stocks is the coding, and maybe they're trying to make a point, right? And I'm not talking about from a performance point of view, because their liberals tend to be liberals. All of those funds don't overweight a particular thing. They try and be everywhere, try and be in the middle.
And they try to be very simplistic about how they do it. But I used to work at GE Capital. His brother worked at GE too.
But that's draconian.
And I can tell you that we spend a lot of time trying to see how we can make coal cleaner, oil cleaner, all of that in terms of technology.
Right.
So I think it's a lot more complex than looking at it as a simplistic lens.
But saying we're not going to own Shell or Exxon, and
It's wrong. It's wrong.
Because number
Yeah.
one, you
Create an
can't,
opportunity that could take off.
you really can't move or function without that black
I mean,
oil.
those companies are making an effort to also become more green and more green technology.
And Shell in that is.
They have the capital to make it happen.
But I would say that is like, and it's the same thing about like investors should have the right to be stupid. If an investor says, I don't want weapons manufacturers in my portfolio because it abides with my personal perspectives on the world, I don't want to invest in fossil fuels, like that should be a choice.
Sure.
And ESG actually is not a investing strategy. It's not like it's just like data that you can evaluate. You know, you're either growth or your momentum or your deep value, and ESG is just another data tool in the toolkit to evaluate. You can decide, I'm not going to look at that, but it isn't actually the basis for how you make a decision. You still will make a decision as a stock cheaper, rich on an intrinsic basis. Top quartile ESG companies, cheaper, rich on intrinsic basis, or events that unlock value. Yeah, but, you know, you're not investing in ESG because the company is a top quartile ESG company. What is profoundly overpriced, right? Like, you're not going to, that's not the reason.
So you might short it.
You might short it, but then that's because that's a value trade. You're making a judgment that it's rich on.
Personally, I agree. That's how I would do it best. I'm not attracted to it.
And there actually are some ESG long short funds.
Well, a lot of them.
And there's a non-ESG ETF that's raised $1 billion.
But a lot of funds, like it was probably 4 years ago. So you had, I'm long green and short black, and those funds obviously the total continuous quagmire of chaos, right? And if you get after that chaos, you've got through to some moderate. And ironically, via the polygon. Okay, you know, the energy companies or Vermont, low, some better than most, everything else, doing some exceptional textiles. Like some of them were down at 1.5, and then they're now trading at 50. Looking at them, I think the average is maybe 4 or 5. This is black oil and gas. Anyway.
Oh, can I just say something on a lighter note?
Of course.
360, one of the best restaurants in Philadelphia.
Oh, that's
That's because it's 360.
There's also one in Warsaw.